Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Messer and Tim Stenevec from Bloomberg Radio.
As we've talked about, though, bond traders who have come to terms with the prospect of higher for longer interest rates through this year are looking toward tomorrow's Fed meeting for really clues on how to game it out 2025 and beyond. That's kind of where we're looking at this point. To be fair, though, we have to get through tomorrow's FOMC meeting and the dot plot, and before that, another inflation print at that 8:30 a.m. Wall Street time. So we'll all be focusing on that before we get to the decision.
Honestly, it sounds like the best day ever for us here at Bloomberg News.
You're just saying that because
it's like, what's great? You got the Fed, you got CPI. What more in life is there to ask for, Carol?
It'll create a new narrative, no doubt about it, or potentially just reinforce the existing one. Let's get to it with Bloomberg News economics Molly Smith. She's here in studio, along with Bloomberg News economics reporter Steve Matthews. He's out there in our Atlanta bureau. Molly, I want to start with you. First up, 8:30 a.m. tomorrow, CPI report. What's expected? How might that shape thinking by the Fed and traders and economists about the U.S. inflation print?
Yeah, it's going to be a real Super Bowl of a day for everybody here on both sides of the building. So it's going to be really busy. So yeah, starting off with CPI at 8:30 in the morning. I think you're probably going to call this maybe moving sideways at best is still probably the story of inflation, or gradually, modestly slowing. So it's really, this is still nowhere near the disinflation that we saw at the end of last year that really was starting to fuel the rate cut narrative. And now it's really just more like treading kind of laterally and not so much those bigger, step downs that we had seen toward the end of the year. But gas prices came down in the month, so that'll be helpful. It really just depends, though, how much broader beyond that the story is, because that's something that Fed officials have been looking for, that it's not just coming from energy and from goods categories. We need to see services moderate as well.
That's a good point. We are a service-led economy. Let's remind
That's
everybody.
Right. Housing especially.
Having said that, a higher print, a lower print, will it just be kind of, disregarded? Because what we keep talking about is we need to see at least 3 reports to show an existed, kind of a really strong trend here when it comes to inflation.
Right. Yeah. And that's exactly the thing. When you had the prints in January through March that all came in above forecast, that really
was a trend.
Yeah, that really reset the clock then on, all right, we're back to zero. We need to now see another 3 prints to establish a trend. And we did get a little bit of that with the April print, that underlying inflation there, that's the core measure that excludes food and energy, that stepped down month over month for the first time in 6 months. That was a huge deal. If that can be repeated, also a huge deal.
Okay.
So, but
If it can be repeated.
That would be important.
Certainly important to keep in mind. Hey, Steve Matthews, come on in here and sort of give us an idea of how tomorrow's CPI report or Friday's strong jobs report and the overall flow of economic data is going to be taken into account when we do get that policy decision. And perhaps, I think more importantly for a lot of our viewers and listeners, the updated summary of economic projections.
These meetings of the Fed have been kind of boring the last several meetings.
Hey, can't say that.
Sorry, Jay.
Sorry.
Hey, if Steve says it, it's true.
Hey, Steve, you can say whatever you want.
You can.
But this is going to be a cliffhanger. This is going to have some fireworks because, the economists that we survey are evenly split on whether the Fed's dot plot is going to show 2 rate cuts for this year or 1 cut. In March, they had 3 cuts that were priced in. We had bad inflation numbers in the first 3 months, as Molly said. April showed an improvement. And what we get tomorrow in the CPI could well set the tone for what happens with the dots. If we get a good number, you could perhaps stay at 2 cuts for the year. If you have 2 cuts for the year, that implies that the first cut could happen in September, arguably before that. So if you get 1 cut priced in the dots, that would suggest you're not going to get anything until after the election. So it's all important. And Jay Powell was asked about this at a recent press conference about, okay, if you get data in the middle of the meeting, do you really change the dots?
Right.
And his answer was, yes, we do change the dots. We encourage the FOMC members to change their dots in the middle of the meeting based on the latest data up until mid-morning of the second meeting. So they can change their dots tomorrow.
Well, wait a minute. And Tim's just like saying to me, wait, even if it's CPI?
Yeah, I mean, we're not talking about PCE here. We're not talking about the Fed's preferred inflation measures.
There are inflation
Steve,
prints,
come on.
and then there are inflation prints.
That's true. It's not the PCE, which is what they target, but it gives a good indication when you combine the CPI and the PPI together of what PCE is going to end up at.
It's really fun because I think the three of us were all thinking the same thing, like, okay, wait, does the Fed pull out like a giant whiteboard and say, okay, guys, we have to erase this because the CPI came in differently? You are saying, bottom line, yeah, if it's something very dramatic, they're going to rethink.
If it is away from consensus, if it is better than expected or worse than expected, they can definitely change their dots and they can change the way the median turns out.
Okay. I guess that's really interesting to hear because I actually thought, Molly, that they wouldn't take into account data that came day of. But look, if it is an upside surprise or a downside surprise, like Steve said, that could be part of the equation tomorrow.
Yeah, it really speaks to that whole cliffhanger element that Steve was telling us about here.
That.
So we're going to be on the edge of our seats in the morning. I'm sure, God only knows what's going to be happening in Washington at that time. And of course, they're going to be looking for that, core services ex-housing number. That's always a big one that they like to look at. So this is like the underlying services inflation in the economy that, taking out housing inflation because that has been so sticky, to just get a sense of what are the kinds of services, like travel, entertainment, other things that Americans are spending on. Where is that momentum heading? So that's going to be another one that they're going to be looking at very closely.
Steve Matthews.
Molly has that exactly right. The Fed is very focused on services, and Jay Powell is very focused on what's happening with services, and that's affected by what's happening with the labor market. So, to the extent that you've seen some kind of moderation in the labor market with unemployment ticking up just a little bit, then if you see that in the services inflation, that would be really encouraging to the Fed.
Well, here's the thing, Steve, because I know that we talk about this all the time in our group, but, I find it hard when we're covering the jobs report and we've got the payrolls survey, with the survey of businesses, the establishment survey, saying one thing with the payrolls number that was so strong last week, and then the household survey painting a very different picture of the labor market. So in your expert opinion, because you are the expert here, what would you say is the Fed's better signal right now of the truer signal of the labor market?
Well, I think that is going to be a really key question for Chair Powell in the press conference, is how does he view the labor market? Because it's like if you look at the job openings figures and the quit rate, the number of people quitting and the job openings per unemployed, all those seem to have returned to pre-COVID levels. So there are definitely some signs of moderation, but it will be really key to see how he sees the labor market, because if he sees the labor market as basically back to balance, then that says that they would be much more open to cutting rates.
All right, guys, sit tight. We've got another great voice we want to bring into this conversation. Back with us is Steve Skancke, Chief Economic Advisor at the wealth management firm Keel Point, former U.S. Treasury and White House National Security Council staff member. Steve Skancke joining us from Washington, D.C. Steve, good to have you here and join our conversation. Curious about what you've been hearing from Molly and from Steve Matthews and what your expectations are about what we get from the Fed tomorrow. It's as I agree with Steve Matthews, a little bit of a cliffhanger. Maybe it's the dot plot. We're just kind of trying to figure out what the Fed is thinking, especially when you have a lot of folks saying, wait, it's not about a rate move this year. Think about 2025 and beyond.
Well, that's right, Carol, and thanks for having me on. I agree. It is a cliffhanger, and there's a lot of ways that it could go. I think, though, we start with the premise that Jay Powell would actually like to send a dovish tone. And the only inhibition to that would be as if we have a bad surprise on the CPI. But absent that, even though they're not going to cut rates, they're going to have a new dot plot. I think there's a growing concern that the economic data are moving toward an inconvenient slowdown in the economy. The jobs number was a surprise, but as you or Steve pointed out, I think, Carol, you pointed out, the household number was 400,000 jobs down, an increase in the unemployment rate, and to reconcile that with 272 after they revised down April to 165, a lot of opportunity to be confused in that. But as you look at first quarter GDP revised down, the second quarter GDP estimates among economists are now being revised down below 2%, and that spells concern.
So
for Jay Powell and the Fed.
So Steve Skancke, how are you thinking about this at Keel Point in terms of how many rate cuts you think the Fed will actually be able to do this year or should do this year? And it gets a little complicated with the whole election coming up in November.
It does. We still believe there's an opportunity for 2 rate cuts. Now, obviously, that could change very quickly if we have higher inflation prints, certainly from the CPI, which is not the Fed's preferred measure, but that then ultimately works itself into the PCE, personal consumption expenditures deflator. I think that they'd like to cut twice.
Yeah.
And so how do they do that? And if they can't cut twice, how does Jay Powell signal to the market that they're trying to go easier in their policy moves? You know, if CPI goes the wrong way, we very easily could see a dot plot that shows rate increases,
right?
Which would certainly disrupt financial markets.
That would be definitely a cliffhanger turning into falling off a cliff, perhaps. But come on back in, Molly.
Right about that.
Yeah. I want to come back to Steve Matthews here. This is something that we talk about before every Fed meeting, and Steve, sometimes it's you who's in the chair in DC who's asking Jay the questions. We talked about one that Powell will probably get is, how are you viewing the labor market right now? What's another one you'd really want to hear Powell answer?
I think, as Steve said, the big question is, how does he see the current economy? I mean, if you look at, for example, the Bloomberg Economic Surprise Index, the economic surprises have turned negative. I mean, we're now seeing data that is trailing the consensus estimates fairly consistently. And, does that raise some concern that maybe the economy is moving to a below trend state?
Right.
And how much worried is he about that? I mean, obviously he's going to be asked about the dot plot and inflation, but it's like just the view of the total economy would be really important.
One point I wanted to bring up, it was really interesting on Surveillance this morning with a guest about how keeping rates more normal, remember what we are in right now is more normal, actually gives the Fed a lot more room to cut rates if and when that is necessary. And that's a good thing. Steve Matthews, you understand how the Fed moves and how it all works, right? The Fed having breathing room around policy is a really good thing.
Yeah, if you hear Powell or other Fed officials in the aftermath of this meeting talk about the Taylor rule and about monetary policy benchmarks, that is dovish, because right now the Fed's rates are much higher than what monetary policy rules would suggest they should be, which is around 4%. Mm-hmm. So there is room to bring rates down just based on inflation right now. If they become convinced that the economy can handle that.
So Steve Skancke, then, is the conversation of potentially a rate hike, is that just completely inappropriate then, based on what Steve Matthews is telling us?
Yeah, I believe that it's inappropriate, and I think Jay Powell probably has some concern about that. If we should see a negative surprise on CPI, the Fed uses forward guidance to constrain economic activity. I think the concern is that they need to encourage economic activity for the reasons that we've talked about. And so I would believe that there's a good chance, absent a CPI surprise, that the forward guidance is going to be toward easing, even though they won't change interest rates for probably the next couple of meetings.
Hey, Steve Skancke, very, very briefly, because we want to do a final round, but just in 30 seconds, what's at stake here if you don't see the Fed cutting rates this year? If that doesn't happen, how would you change how you advise the folks at Keel Point?
Well, the economy is fundamentally okay, but the downward revision that we've had in GDP growth and some of the mixed signals in the labor market certainly generate concern. Now, earnings growth continues to be remarkably positive, and so on that front, we're certainly positive. But we're very cautious if the Fed continues to hold tight and doesn't signal a willingness or desire to loosen. We think that'll work poorly for the economy and ultimately financial markets.
All right, our rapid round as we get ready to wrap up. And I'm going to start with you, Steve Skancke. Very quickly, what would be a surprise coming from the Fed tomorrow? And you do need to be quick.
Well, for CPI to bump up and the dot plot to show a heavier orientation toward raising rates.
Wow, that would be crazy. Steve Matthews, real quick.
I'd say the dot plot showing just 0 or 1 cut, and also for long-term rates to in the dot plot to move up in the neutral, so-called neutral rate.
That would be our new narrative. Molly Smith, saving the last 30 for you.
Maybe if Powell were to say that the labor market is still very tight, I think that would be it would be questionable of how he would fully support that. I think there are a lot of other data points that would maybe suggest otherwise.
Which is interesting, right? Considering the mixed signals in the labor market. If he comes out and says that they're tighter.
Them all.
You guys, the trifecta. Molly Smith, economics editor at Bloomberg News, right here in studio. Steve Matthews out there in our Atlanta bureau. He is our economics reporter, follows the Fed for us. And Steve Skancke, a regular guest here on Bloomberg Businessweek, chief economic advisor at Keel Point, former U.S. Treasury and White House National Security Council staff member.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
We do want to talk a little bit about Apple. It's your number one gainer in the S&P 500 and the NASDAQ 100. What's interesting, Apple investors not impressed yesterday. And we also saw shares of some key Apple suppliers sinking overnight as well following their big event that got underway yesterday. But as we said, very different tone. Apple shares at a record after that great AI reveal. We want to get to it, though, once again, and lucky for us to have back with us our own Bloomberg News chief technology correspondent, Mark Gurman, who continues to write about everything that we are getting from the event on Apple and just Apple in general. Mark out there in LA. So, Mark, what happened? Apple shares traded lower yesterday. We talked to you, rallying big time today. When we talked, kind of following the keynote, you said your view was that we kind of saw nothing better than or different from the competition, except marketing and a focus on privacy. And I love something you said was that they showed up to a party without a gift. It was like something we thought just said so much. So what's happened in the last 24 hours?
Well, like I said, they rolled out a bunch of new AI features with a privacy stance, with deep integration into their applications. They didn't bring anything new to the party, but they did it in an Apple way. But the most important part is they showed up to the party, I guess. And it took investors in Wall Street some time to realize that Apple is now here. With or without something new, they've arrived. The concern on Wall Street was that Apple would never show up, or they wouldn't show up for a couple more years from now. But they worked as fast as they can. It was a 1.5 year Herculean effort to get Apple Intelligence to market. They had all these AI features under development, but no synthesized, no integrated package. So it took a while to put it all together.
Okay.
And they did that. And it's not going to sell new iPhones, I believe. It may spur a small number of upgrades, but more importantly, it's going to lock people into the ecosystem. They're going to keep their existing user base, and they're not going to lose people away to Android and other AI-driven platforms because they did this. So it was critically important for them to do it, regardless of the fact that nothing they brought to the table here is especially new.
Mark, why don't you think this is sort of a huge prompt for a super cycle upgrade here? Why don't you think it's as big as adding 5G to the phone, for example?
You know, quite frankly, I didn't think 5G was a super cycle moment either. And it turned out that way. I mean, iPhone sales growth has been stagnant even prior to the 5G iPhone. But like with AI, what 5G did is it kept people within the ecosystem, and it didn't allow people to switch away to rival products that had 5G while Apple didn't. And so AI is in the same nature. It's going to keep people within the ecosystem. I don't think if someone has an iPhone 14 Pro today that they're going to upgrade to the iPhone 16 just because of those AI features, right? I think that down the line, a year or two from now, when they're ready to upgrade, that's going to ensure that upgrade happens.
I'm going to say that my household, we're a bunch of tech simpletons because I think the 5G, we do the upgrades on the Apple phones.
Are you still back there? Is that where you are?
I'm at a 12 and I'm getting ready to upgrade this come fall.
I think that makes sense that you'd upgrade from a 12 to a 16.
Tis time. The formal announcement with OpenAI.
Let me jump in. Jump in here. If Carol was, really focused on artificial intelligence and wanting the latest and greatest technology, and she has a 12, the 16 comes out later this year with no AI features, right? Maybe she takes a look around and says, AI is all the hype right now. That's the vibe right now. Maybe I should take a look at Samsung or Android, which are completely AI-ified. Now the iPhone has AI, just like the competition, right? Not a ton different, but they're there. And now she says, you know what? Of course I'm going to get this new iPhone. So I don't think it's going to spur upgrades and get people to run out to buy them, but it's going to ensure those people who are already thinking about getting that phone pick that iPhone instead of moving away to Google or Samsung.
And I will say, Mark, and I think we've talked about this before, and we're a household where it is all Apple. And, my daughter, when she was younger and tried to deviate, we're like, no, that's not happening. So it's like we kind of continue to embrace. I do want to ask you, though, about the partnership with OpenAI, right? The formal announcement, we got that. How important is that? And is it any different from OpenAI's other partnerships that are out there? And is it always different because it's just Apple doing it?
Oh, the OpenAI partnership with Apple is incredibly different. So let me give you some perspective here. So Microsoft, they rolled out a ton of AI features on their computers and their other operating systems for both their in-house devices and third-party devices. The underlying large language models and underlying technology that they're using for nearly all of their features is powered by OpenAI. Apple's feature set, 90% of it is powered by Apple large language models, underlying Apple technology, Apple servers, etc. Only the chatbot portion, primarily, and some of the writing assistance tools, those are powered by OpenAI large language models and ChatGPT. So the OpenAI portion of the overall Apple intelligence story is actually only a very small sliver.
Is it integrated at the OS level? And you can probably guess why I'm asking this, Mark, because
I can guess why you're asking. Let me say a few things about that.
Okay, good. Because, I want to introduce it because I don't think everybody is totally caught up on this. Yesterday, Elon Musk said he would ban Apple devices from his companies if OpenAI's AI software is integrated at the operating system level. He called the tie-up a security risk. Okay, go ahead, please.
Something integrated at the OS level, that is a vague term that can be interpreted in many different ways. So it's not entirely clear what he means by that. If you ask me, OpenAI is indeed integrated at the OS level. And I'm sure Apple would agree, but I'm sure there's some other people who would say that it's not integrated at the OS level. It's built into Siri. It's built into the OS. It's a chatbot. It's not just an application. It's not just a layer on top. It is fairly integrated into the operating system. So I would say, yes, it is integrated. But just because it's integrated at the OS level doesn't mean there aren't parameters and what's known as sandboxing implemented into the coding infrastructure that can separate what goes into ChatGPT from the deeper core of the iOS foundation, right? And so it's up. The burden of proof is on Apple and OpenAI to show how privacy-centric the ChatGPT elements are of Apple Intelligence. Apple did a 15 out of 10 job yesterday showing how private and secure their artificial intelligence technology is for the phone. That's the Apple LLM, how secure their compute cloud is for the LLM that runs in iCloud. They did an amazing job on that. What we didn't hear a lot about is the privacy protections that OpenAI are implementing. From some standpoints, you can say it's just, trust us. Maybe Apple could say a little bit more there. Either way, I think that Elon Musk is competing with Apple and OpenAI here. He has Grok from XAI. He has a terrible interpretation of Apple and feeling towards Apple and their App Store rules and the fees they take from subscriptions on their platform. He clearly does not like Sam Altman, right? He's embroiled in all sorts of things regarding Sam Altman and OpenAI.
He was a co-founder of OpenAI.
He was a co-founder back in the day of OpenAI. They had a falling out. So his perspective isn't exactly kosher on this situation. But he raises real privacy questions regardless. I just think he's way overboard on it.
Okay, that said, Mark, how realistic is it that he could ban these devices at his companies, given that they're ubiquitous? And I can't imagine employees, putting them in some sort of box or leaving them in their cars. They walk into work at SpaceX or the Boring Company or Tesla.
It's a top 10 most ridiculous Elon Musk tweet, right?
Okay.
That's not going to happen. I mean, imagine like showing up to work and like all of a sudden, you can't bring your Apple devices in. You have to leave your iPhone in a Faraday cage outside the office or leave it in your car. That's just not going to happen, right? He's already laid off thousands of people from his company, or tens of thousands of people from his company. I'm not sure he can afford to have people quitting in large numbers at this point, but I think that's going to upset a lot of people.
All right. We always talk about the importance of the Chinese market to Apple. Is there something here in terms of what we're hearing from this event and, what they're doing in terms of AI that kind of moves the needle potentially in their sales over in China?
Yes. Good question. This is a point that, quite frankly, I should have made earlier. Nothing. Apple Intelligence, at least the first iteration, is only available in U.S. English. Yes, in U.S. English. So there's going to be a long ramp up here until they're able to get it in other languages. Now, let me give you some Apple history. When Siri launched in 2011, it only launched in English and a couple other languages. But 1 year after Siri initially launched, they released so many additional languages. In Siri today, it works in every Chinese dialect. It works in many countries. There's no barrier to using Siri, regardless of where you are in the world in most cases. And I would have to imagine that getting Apple Intelligence to work properly outside of the US, outside of just US English, is going to be a very high priority for next year. Yeah. And so I would anticipate China next year. Now, one other piece of evidence about how Apple sees China, it's going to be one of the first markets to get the Vision Pro this month, just a few months after it came to the US. Right. So clearly they're thinking, US first, right?
Yeah.
China second. And it's not like China's like down the list. Right. It's a priority. So I would imagine the AI story for China is going to get buttoned up sooner than later.
Everything we need to know about Apple. Mark Gurman, you rock. Bloomberg News Chief Technology Correspondent. Mark Gurman out there in LA. That is our top stock story. The shares of Apple are rallying.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Okay, Apple, a top stock in business story today. Tomorrow, as you know, it's all about the Fed and its impact on markets and mood and transactions, which brings us to Jim Gold, CEO over at Steward Partners. It's a financial services firm. They've got about $35 billion in assets under management. Jim's here in the Bloomberg Interactive Brokers studio, waiting patiently while we go through everything that happens at the close.
It's been one of those days.
It has been one of those days.
Just when we think we have our course, like something gets thrown at us.
Hey, as I was preparing for this, I went back and saw a note from Barclays last month that said M&A volume has risen 17% so far this year. The investment bank's model projects 15 to 20% growth over the next 12 months to $1.8 trillion. They also reminded us that activity in 2023 was the slowest in a decade. Remind us of how you play in the M&A space over at Steward Partners and where you see the market going this year.
I think the M&A space is accelerating, and I think the figures we see publicly are, I think, actually woefully underreported because you think about the smaller end of the scale where advisor A sells to advisor B, and there's not a banker involved. No one reports on that transaction. So I would say there's probably hundreds more transactions that are out there. I think another trend is what we look at as breakaway M&A. So an advisor from a big four wirehouse firm leaving to go somewhere. The assumption is they're getting recruited, but in actuality, more of them are actually selling the business today. So the M&A...
So that's M&A?
Absolutely, because they're selling the business, yeah.
Well, that's what I was thinking about. You guys are really involved, right, in ownership, the private equity or like company ownership of deals, and that's where you kind of play in that space?
So we offer optionality. So we have the ability for advisors to affiliate with us, and they own their clients, and they just want to work with the Steward organization.
Yeah.
And then we also offer people the opportunity to say, hey, I'm 5 or 6 years from retirement. I want to sell you guys the business. Help me figure out my succession plan.
Liquidity event, right?
Right.
Yeah. No, continue. Yeah, please.
Yeah, there's a succession crisis going on in wealth management. I think it's driven by the boomers actually are working longer than expected because they're healthier and markets are good, they make a good living. And now all of a sudden they're getting into their 70s and saying, wait a minute, I got to wrap this up at some point.
I know somebody like that. He, has a wealth management business with a big firm, and he's got all the clients that he's had, and he's in his 70s, and he's like, what am I going to do now?
Right.
Who's going to buy this thing? His kids don't want to get into the business.
But G2s don't have the money either.
His kids' partners don't want to get into the business.
Right.
What are his options?
Well, I think the option there he has to look at, and I think at the bigger firms, the challenge they have is that there's only one bidder. So how do you know what the real value is? You have to test the market, right? And then the terms around that.
Isn't it pretty simple, though, to know what it's worth? You have assets for that kind of business, assets under management.
It's so different. If you stay in that channel, because they control, they're the only bidder. So there's a very suppressed valuation. And
but I mean, isn't there a way to create a valuation model based on comps? Because what are the comps for that type of business? Isn't it just like, or the multiples for that type of business?
Well, you're going to see, if you look at multiples of EBITDA and the smaller end of the scale, so say sub $1 billion asset firm, they're going to be, high single digits, approaching double digits, depending on the other criteria, things like growth and how old are the clients, is the business growing, is the business shrinking?
Meaning a firm with $1 billion in assets under management would sell for $10 million?
Yeah, or more.
Okay.
Yeah.
Interesting.
Jim, how much pressure is on private equity firms? What are you seeing to do those exits? Because they've been holding for a while, because the environment hasn't been a good one. But they eventually are going to get pressure from their investors, and they want to free up, capital. I know private credit can come in and help them maneuver through that. But how much is on private equity, and how much does that mean in terms of the M&A environment picking up a little bit?
Well, you have to have private equity, right? Because they provide the capital, they provide the fuel. And I think, the better private equity firms are getting creative where they're now having funds that are 10 years shelf life. They're not the typical 5-year where they need to turn them and flip them. Look, at the end of the day, private equity is happy to be illiquid as long as they're getting illiquid rates of return. But I think the challenge they have is finding the right partner to actually execute on that. Right, they're not directly getting involved. They're funding a company like Steward. We're not owned by private equity. We have 2 family offices.
Right.
But they're the capital behind the capital. So what they really have to find is the right leadership team and the right company that has the scale and the resources to actually go out and execute on an M&A strategy.
So in terms of the deal activity that you're seeing or expecting, what does it tell you kind of about the broader macro environment? I feel like folks like you can kind of see a lot when we are seeing cross currents when it comes to some of the kind of, fundamental traditional statistics.
I think the challenge for advisors who think about succession, I think the mistake that's made is this should be a 3 to 5 year plan. Don't decide today you're going to retire at the end of this year, right? You have to think about your clients, your team, valuation, structure, who's your successor. I think the older folks, maybe the gentleman you mentioned who's in his 70s, they can't wait for another market cycle maybe. So they're starting to go, hey, the markets are pretty good here. Maybe this is the time. And maybe I can't wait 8 more years to do this or 7 more years to do this. So I think the demographics are forcing some people to make a decision now because they don't feel they have a runway to wait through another market cycle if that's where we're headed.
What percentage, though, are of the deals that maybe you're looking at or seeing are people who are pressured that have to do something? How much are more just still kind of waiting for the right environment?
I think most of the folks we're talking to are in their 60s. A lot of these are bigger teams, though, that will have G1, 2, 3.
Yeah.
So they're saying, hey, to the point you made earlier, my G2 and 3 don't have the capital to buy me out, right? I don't want to leave immediately. So this is really my 5-year plan, but this team's going to be here forever. So we love that because we love the continuity with the clients as well.
Right.
Yeah.
What do you think of the idea of the wealth management business? I'm not going to say losing relevance, but what I'm going to say is that increasingly you're seeing study after study talk about passive investing, the rise of passive, just investing in index funds. And I'm wondering if there's this new class of investors who are less interested in paying high fees for their money to be managed and more interested in just setting it and forget it.
Right. There's an old cliche. They say the fees, the fee only matters in the absence of value. So I think the need for advice is always going to be there. If you look at the studies on wealth creation, there's more wealth being created than ever. The more wealth you have, the more complex your situation is and you need advice. I think the other trend that's really interesting, and it's good for me on the side of the space that Steward sits, which is the independent space, overwhelmingly the sub 40 advisors want to be in an independent firm. They don't want to be at their mom or dad's wealth management firm.
Right.
So that's driving a lot of this flow to our side of the space as well. So the market may shrink, but the assets are growing and the headcount is shrinking. So you actually might still have more assets and revenue per advisor with a smaller sales force.
Do you see those younger advisors, those sub 40 advisors, changing the way they're charging clients, maybe doing an hourly rate versus an assets under management rate?
We haven't seen it. We think the asset-based pricing seems to be reasonable, and they can use some of those tools. They can use index ETFs and things like that where appropriate. And listen, I think the ROAs are coming down across the space, but they've always come down.
AI, how do you think is going to, I just came back from Nashville, Pershing, BNY Mellon, doing their inside event.
We had a whole team there.
Yeah, and it's really fascinating. Of one of the conversations during a keynote is that what does the future financial advisor look like? Right. What does the future investor look like and what they want? And we tapped into a lot of longevity as well as a younger, investor. So how are you thinking about that?
I think AI is going to be amazing. Actually, our CIO actually spoke at the Pershing conference. Yeah,
it's a great feel of kind of what everybody's thinking.
Yeah. Listen, I think it's another, some folks are taking this as the latest threat to advice, right?
Yeah.
And it's like, online trading and advice is going to be free. Listen, I think it's going to be amazing for both the client and the advisor. I think the COVID world changed how clients say, hey, I don't want to hear my advisors out of the office. I'll just FaceTime them or text them or Teams them or whatever I can do to get a hold of them.
Right.
So I think AI is going to create amazing tools for the clients and the advisors to interact. We're seeing some of them already, and our CIO knows what he's doing. I don't. I tend to lock myself out of the computer once a month. So, but we're excited about AI. We think it's going to be great. I was an advisor back in the 90s when the internet was a new thing. And you think about, I remember Sandy Weill once said this. He said, they asked him about.
Formerly of Citigroup.
Correct. And they asked Sandy about the internet, and he said, listen.
Sorry, there is a whole generation that's out there that does. I know. I feel like such an idiot.
All you got to do is go to Weill Cornell and see whose picture is on the
I know,
wall.
but I'm feeling like I could ask a fair amount of folks.
I'm a grandfather now. I know these things.
I remember, right? You remember him creating, what is now Citigroup. But anyway, forget it.
But his quote was so prolific. He said, listen, 85% of the internet-based companies today will be bankrupt in 10 years. And the 15% left, and you just talked about some of them, are going to be worth more than all of them combined.
Right.
And I think it's
Apple,
the same thing
Oracle,
with AI. There you
Amazon.
Go. Exactly. And they were all around then. I'm old enough to remember some of their IPOs.
Really fascinating. Interesting time to be kind of in the markets.
Amazing time.
Amazing because of opportunity?
Yeah.
Really?
Always opportunity.
Always. Well, but there isn't always. Well, I guess there is. You just have
They're
to be
always
patient.
out there. You just got to look harder sometimes.
Jim, this was fun. Thank you so much for being patient. We had a lot going on, and we really appreciate it, and you being really flexible with our team. Jim Gold, Chief Executive Officer of Steward Partners, joining us right here in our Bloomberg Interactive Broker studio.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Well, you may have missed this past month, Carol, but luxury home prices in select Asian cities are soaring, bucking a downward trend in more established markets, including here in New York and across the pond. Over in London, we're talking about prime property prices. They're defined as the top 5% of the market. They fell more than 2% in New York and London in the first quarter compared to the same period a year ago. That's according to the real estate consultancy Knight Frank.
All right, so let's get a check on the luxury real estate market, residential real estate market. Louise Phillips Forbes is a real estate broker with Brown Harris Stevens here in New York City. She's been in the business for more than 30 years. She's seen different cycles. She has sold more than $5.5 billion worth of real estate, specializing in luxury residential sales and development projects. She is back with us here in our Bloomberg Interactive Broker studio on a little bit of a busy Tuesday, and also on an interesting day where we're talking a lot about kind of the economic backdrop and the rate environment. First of all, welcome.
Thank you.
How does the market feel right now, this moment in time?
Not quite the same as it was a couple of months ago when I was here. There is...
What's different? What's changed?
I think that there is, it's not a pause, but there is, I think individuals that a month ago, they might have pulled the trigger that they're still contemplating, because I think, remember, at the end of the year, we were expecting 5 rate reductions.
Right.
And we haven't seen really any of those. In fact, we've had conversations about it coming up. So for some of those people, it means holding off. However, what's right for one person is not always right for another.
What's surprising for me to hear from you about this is supposed to be the busy time of year. I mean, spring ahead of summer, and you had a great first quarter.
I had a record. I mean, almost 100 million in sales.
But that's supposed to be a quiet time, right?
No, not necessarily. The cycles are off because of COVID. Number
Really?
one. Number two, you have to realize that people have been holding off what decisions that they make since 2019 for many people.
So is that why people finally pulled the trigger?
Yes, and I think
quarter?
I believe psychologically I think that people believed that the interest rates were going to follow.
How many of your buyers are buying with a mortgage versus cash?
Very few right now. Ironically, of the 32 transactions, so the average deal is
From
not
the first quarter?
the average deal is not 38 million. The average deal is 3, 6, 5, 2. 600,000.
With mortgages or mostly cash?
All cash. All but 7.
All 7 of your first quarter deals.
63% across my business was a little higher, but across the market was 63 in the first quarter.
So
percent.
Why did they pull the trigger then? Is it just that they were so for them the rate environment wasn't so much
cash is always
catalyst.
king. It is always king, and it also, you got to remember, some of these sellers have been waiting for 9 months, 12 months.
But that's what I'm saying. So it's not like, okay, they thought maybe it had nothing to do with the rate environment or anything. They were just held off.
It's a negotiating tactic. My experience is that if I have 3 offers on a piece of property and one's a mortgage, and I'm able to push the cash person or even choose to take less because they're cash.
So it was seller driven.
Them having a choice was very powerful and important and new.
Yeah.
They hadn't experienced that in a while.
Can you talk about, I think this is unique to New York because there are so many cash deals, but can you talk a little bit about why a cash deal is so much more appealing to you than a deal with financing that could come in at a higher price?
Have you not seen the reality shows where they're like, it's a cash deal, it's even lower, but
and you're closing next Tuesday.
And they're closing next Tuesday, done. Like, it's fascinating.
Yes. And you have like 11-inch heels on while you're doing it.
I know. And they look perfect. I know. It's like a little unreal, but anyway.
I haven't seen any of these shows. I don't know what you're talking about. Okay.
Okay. So, no, listen, the preference becomes about cleanliness, meaning you go to contract and then you don't have an appraisal. Like, how would you feel if you had 5 bids on a piece of property? Which, by the way, this happened all through the new year for myself.
Right.
And then it doesn't appraise. You have no contingency, but how do you feel as a buyer? Mm-hmm. How does a seller feel? Mm-hmm. Does somebody walk? So it's just cleaner if you have the luxury of that choice. Otherwise, it's our job to be able to make things appraise.
How do you then, in your world, where you're dealing, obviously, where some people who are listening are being like, I'm going to throw up because it's like $5-6 million all cash. Like, it's not a slice of total American life. It is a slice,
right?
A small slice. Having said that, what does it tell you about the broader economic environment in a world where we, Louise, have so many conflicting data points?
Yes, and I don't think that's going to change for a while, Carol.
Okay.
I mean, listen, just remember that when interest rates are high, the rental market is high.
That's true.
Have somebody relocating here who got into the New York Academy of Arts, and they are relocating here, and we were looking for $9,000 rental, 2-bedroom. The same apartment 2 years ago went for $5,800, and it came on for $7,900, and it went for $83 in 2 days.
That's wild.
So
we're talking a rental.
That is a 47% increase
in
2 years because the cost of money is cheaper. I mean, the cost of money is more expensive.
Yeah.
And that
so buying is
so when
tougher.
Interest rates are up,
yeah.
Buyers they get on the sidelines and they rent, and they are affected. So
you're saying that people who are not buying are driving up the rental market?
Yes.
But
absolutely.
you're also saying it's a tougher environment. And says something more broadly macro, right?
I'm talking about for the lower end of the market.
Yeah.
Right? So I have somebody who's contemplating selling a townhouse for $6.5 million. And they're like, the cost of my capital, I can rent something for $15,000. When he goes to look at what you can pay for $15,000, he's like, I'm going to wait a year.
Huh.
So
wait to sell.
Yes.
Okay.
Because
interesting.
It's sometimes some of this is a luxury.
Yeah.
It is a luxury. And again, I ask the same question whether it's a $20 million buyer or a $600,000 buyer. Do you want to pay your own mortgage, or do you want to pay somebody else's mortgage? Because that's what it is, whether you're in a rental building. And so it's the whole thing around waiting for the election. Like, okay, but whoever ends up being our president is going to be our president, and you are still going to need a place to live. So I do think that you can try to time everything, but it's really about understanding I have people that are borrowing money from their grandmother who is going to inherit, 92 years old, and he's like, I'd love to be able to use it while you're alive. And that is what they did. And so people are getting creative, and it is what my recommendation is whether you're borrowing from your sister, you're co-owning with your parents. I'm thinking about, I have a son that's going to be 21 years old who's looking at real estate every day. Like, I want to buy my own apartment. He wants to buy an apartment where he can have a roommate. He doesn't think he can afford to live by himself.
Yeah. I get one last question. Does what goes on in office, does it matter? Does it impact you at all in terms of certain neighborhoods, or not really?
It certainly skews people's, they're more cynics that are in that field. I mean, a lot of my business are commercial brokers that I do business with, meaning helping them personally with their homes. Yeah. And,
they're feeling squeezed.
They're like, oh my God, how are you holding up, Louise? And I'm like, okay, I don't even want to tell them. So because
they are feeling so squeezed.
Yes. I mean, the New York Times, there's a building on Times Square that just had a short sale, like, I don't know, was it 62%?
Yeah, it's pretty, yeah.
So, but this is the way that commercial market works, and the way lending works, and the way that they use the leverage. That is the science of that business. And that is always going to find cycles. It's going to have cycles, whether it's 15 years or 7 years or 4 years.
Right.
I just want to mention, you're talking about Empire Capital Holdings and Namdar Realty Group agreeing to purchase that property at 321 West 44th Street for less than $50 million.
But they bought it.
Yeah, it was a New York City office building owned by a related company affiliate, set to be sold at a steep discount, 67%.
We're going to say goodbye. 20 seconds, or 10 seconds, the word to describe the environment right now for you.
The environment is, when it's the most scariest, is usually when the best opportunities are.
But it's not scary now.
Unless it gets scariest.
It's not scary.
But let's be clear, that was more than one word.
I was going to say, come on.
It doesn't feel scary. I mean, regional banks aren't collapsing. We're not in the throes of COVID.
I'm always bullish for NYC.
I love it. And you've seen a lot. No doubt about it. Louise, thank you so much.
Thanks, guys.
Fun to have you. Louise Phillips Forbes, real estate broker at Brown Harris Stevens.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, guys, got about 18 minutes to go until the closing bell on Wall Street. Having said that, one other stock we want to bring to your attention, Tim, we're watching shares of Paramount. They're down about 8% here in the trade.
Yeah, this after Sherry Redstone's National Amusements decides to stop talks with Skydance. This according to a report in the Wall Street Journal. Those shares quickly dropping down 7.5% right now. The Journal reporting that NAI has decided to stop discussions with Skydance. And that is causing a sell-off in the stock.
Yeah, and here's why, right? Those previous reports. Listen, we have been following this story now for, I feel like, months. It's been a long time, or maybe...
So long, Carol.
So long. I do wonder by the time we get to December whether or not there'll be some kind of resolution. But National Amusements, you might remember, that is the company that controls Paramount. They had been in advanced negotiations to sell a majority stake in the company to Skydance, according to previous reports. But again, the Wall Street Journal saying that National Amusements has decided to stop discussions with Skydance. So right now the stock down almost 10%, shares of Paramount. So keeping an eye on that.
There were other suitors out there.
I know, but it's
for parts of the business.
Yeah. Several people, right?
Yeah.
So anyway, stay tuned, as they like to say. We do want to get to, though, our drive to the close guest. Delighted to have back with us Larry Pitkowsky. He's managing partner and portfolio manager at Goodhaven Capital Management. Larry, joining us from Millburn, New Jersey. How are you? The trade, less than 24 hours away from the Fed decision and an inflation print. I don't know. What's top of mind for you in terms of the investment environment, Larry?
Well, Carol, nice to be here. Tim, nice to be here. I'm sorry to disappoint you that what the Fed's going to do tomorrow is actually not top of mind. I think in whatever area you're investing in, if you want to try and generate outsized returns, you have to try and find things where you can have a non-consensus opinion about what's going to happen, whether it's a company, a sector, an industry, a commodity, or whatever, and then, of course, be right. And at Goodhaven, we don't think we can develop a non-consensus view about what the Fed is going to do tomorrow. So we're really just not focused on it. We'll just assume whatever the consensus is.
You sound like, is this one of those things, Larry, like, it's like, I can't do anything about it. The Fed's going to do what the Fed's going to do, right? And then we just got to kind of follow along.
It's like what my mom always says, like, worry about things you can control. Don't worry about Jay Powell. She didn't really say that.
I've got a husband at home like this,
worry
too.
About things you can control.
And your mother has obviously, had the right idea. Yeah. But we do try and find individual securities every so often where we think we can develop a non-consensus view, and then we just got to be right, and it's worked out, pretty well lately. But we don't think we can have an opinion on everything going on out there, and nor do we think most people can.
All right. So what does drive your investment decisions right now, and what does that lead you to in terms of either particular areas or names right now?
Well, here's how we think about the overall environment out there. It's kind of 4 environments are normally taking place, 1 of 4. Okay, the first 3 are rare. Things can be very euphoric, in which point you should be a little bit fearful. Things can be, a lot of negativity. You should be a bit more aggressive. There can be existential periods of true worry, like COVID, great financial crisis. But most of the time, the economy is a little warmer, it's a little colder, interest rates are within some kind of a range, and you should just keep turning over rocks looking for a handful of things that you think you can understand a bit better than everybody else and where you can buy them with a margin of safety. So that's how we think we are in environment number 4. And by the way, we think we're in environment number 4 most of the time.
Okay, so let's get to some of the stock picks, some of these rocks that you believe you have uncovered, where there are opportunities. We love it when you come on and bring us stocks to talk about. Ticker VTS, Vitesse Energy.
It's an E&P company, right?
Yeah, what's going on?
Well, it actually is not an E&P company. Carol, companies often have these 60-page PowerPoints where they explain what they do, and they're filled with words that you got to keep reaching for a dictionary and saying, what the heck does that mean? Vitesse has I think it's 24 words that explains what they do. And it goes like, Vitesse is focused on returning capital to its shareholders by owning financial interests as a non-operator in oil and gas wells drilled by the leading U.S. operators. That's it. They are a capital provider to the bigger E&P companies who want a partner to share in some of the costs and, of course, the returns from oil and gas wells.
It's like a rich uncle, right, for the E&P industry?
Well,
or aunt? No,
a rich, very smart uncle.
Yeah.
And the history of Vitesse, at Goodhaven, we are always keeping an eye out for spin-offs, because spin-offs from larger companies are often an area where there may be some mispricings or where they may get left behind, or for whatever reasons, often have to do with market dynamics. People receive shares in the spinoff. They don't know what to do with them. Vitesse was part of Jefferies for a long time, and we had the good fortune to watch the management team, Bob Garrity and Brian Cree, operate very successfully. It was spun off in early 2023. It's a modest-sized company, less than $1 billion market cap, and it's got a very talented management team that has, as I like to say, dirt under their fingernails. They know every rock in the Bakken, which is where they are focused on. So we have a stock price that we think is about, 11 times forward free cash flow, 8.5% dividend yield, a small company. And with all of the mergers taking place in the E&P space, We think that bodes well for some crumbs left by the big guys, which will turn out to be potentially very valuable crumbs, and then some for Vitesse.
Really interesting, and I appreciate you walking through the story, because I feel like fundamentally that's kind of the stuff we care about. 20 seconds left here. We've been talking a lot about Apple this week. Anything in the tech area that you're finding interesting, and just real quickly?
We have a long-term holding in Alphabet, which we remain very comfortable with. It appears to be reasonably priced, and we think that it's a long way from figuring out exactly who wins in AI, but they have the resources, the people, and whatnot, and we think we're very comfortable there. We have an indirect holding in Apple through a long time, our large position in Berkshire Hathaway. And we will continue to look, we think, trying to understand exactly how it all plays out. It's early days, but we're comfortable with the exposures we've got, and we don't think we have to have an answer to every aspect of it.
That's very fair. All right, Larry, got to run. Thank you so much. Larry Pitkowsky, he is Managing Partner, Portfolio Manager over at Goodhaven Capital Management, joining us on this Tuesday.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.